morning. You know what the big red breaking headlines mean. It's Jobs Day here, January 6th in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. And we are seeing futures not move very much, as they tend not to, ahead of the expectations for the jobs report. And here are the expectations. We are looking at a growth in non-farm payrolls of 202,000. That's what economists on average are expecting. Unemployment rate remaining at 3.7%, which would be no change versus last month. And then looking at a year-over-year average hourly earnings gain of 5%, that would be a tenth percentage point slower. Although month-over-month is really, I think, what I'm watching. That will be 0.4% according to the average economist estimate. So that's the big picture of what we are looking for here. And of course, there's going to be a lot of talk about the read-through for the Fed. If the jobs market is still too robust, is still growing too quickly, does the Fed need to be more aggressive?
You're right. What people can't see, our studio is actually lit up already here. For one of the first times I've actually seen this. Hope it's not an ominous sign of what could be the market reaction to this report. To that end, let's pull up the chart that I'm watching, and that is average hourly earnings by sector. This chart comes to us compliments of the folks over at Citi. And as you can see in this chart, despite the economy slowing down, wages in this country by sectors, by and large, continue to trend up. And if that is continuing to be if that was the case again in December, maybe it continues again into January, I would argue, Brad, maybe we do get that red day for the markets, because it has not been, the market has not received good news in a good way.
Well, if the ADP private payrolls number is any precursor, then we could need to brace for what this number may actually look like. But then there's also the added factor of the number of layoffs that have started to roll in as well across companies. And when we really think about how that's impacting over the long term and mirroring some of what we've seen in past recessions, one particular chart that I've been keeping a close eye on is this BLS duration of unemployment, to really get a sense of how long people are staying unemployed for, where they're trying to still work or look for work out there. And that's starting to now tick back up again. You saw that continue to move lower, of course, off some of the unprecedented highs that we had seen during the pandemic. But then that continued to move lower all the way until early first quarter 2022. Since then, it started to tick back up, and that's going to be a big figure to keep your eye on going forward, to really get a sense of if people are able to make their way back into the labor force as well.
And then what I'm watching is the divergence in the household survey and the non-farm payrolls number itself. So non-farm payrolls, of course, is where we get the number of jobs added, right? And that comes from companies. The household survey, which is usually what we track for the unemployment rate, is just that. It's the household survey. They ask households who's employed, who's not. But the household survey also has a job addition number. And as Bloomberg Economics points out, they've been diverging. And that's why the folks over there think that actually the household number is more accurate. We're going to get revisions lower to the payrolls number. So maybe a more negative, somber sign for the jobs market going forward, but something to continue to track here, because we always like to pay attention to unusual divergences.
And a somber note, like you mentioned, Brad, these tech layoffs that have happened this week ahead of this jobs report. Salesforce early in the week laying off 10% of its workforce. You had other companies coming out here also letting Amazon letting workers go 18,000. I got a good viewer question real quick. As they are watching this, are you reporting about the 18,000 people being laid off by Amazon? Well, we have reported all week, but I will say a number like that does not show up overnight and will not show up in this report. And even in the case of Amazon, it's not like all 18,000 cuts happen overnight. And similar to Salesforce, these cuts will come over a series of months, and in some cases, in the case of Salesforce, years.
And it's part of the staggered impact that some businesses are or have already kind of factored in or have already experienced, or are bracing for ahead of time and trying to move costs around, kind of reduce some of their cost structure, and then just reallocate some of the headcount capital that they have internally as well. But at the same time, the people that are out in the labor force now looking for jobs, it's a question of where they will find them, given that there is that belt tightening taking place.
Right, where and if they will find them right now, because there are still firms that, of course, that are hiring. Well, we're just about 30 seconds till the report, so might as well give you the expectations once again as we set up here. 202,000 is the headline number that we're looking for. Payroll additions, 3.7% unemployment, the 5% year-over-year gain in average hourly earnings, 0.4% if you're looking at it on a month-over-month number, which we are, because we are looking for momentum in inflation. Is the rate of change in inflation slowing down at all as we get these numbers here this morning? And so just waiting for the numbers to drop here as we're looking. 223,000 is the number that we are getting on non-farm payrolls here, above the 202,000 that economists were estimating. The unemployment rate ticking down quite significantly, 3.5%. 3.5% is the unemployment rate that we're looking at versus the 3.7% that we're estimating. And wage growth is slowing, 0.3%, half the month-over-month gain that we saw last month, and 0.1% slower than estimated. That means the year-over-year gain in average hourly earnings, 4.6%. Average hourly earnings, average weekly hours, ticking down to 34.3. Labor force participation ticking up very slightly, 62.3% is where we stand on that figure right now. I'm also seeing some of the revisions populate right now. We are seeing a slight downward revision in payrolls for November to 256,000 from 263,000. And actually, the unemployment rate is getting revised downward to 3.6% for the month of November. That's a little bit unusual. We don't usually get revisions in the unemployment rate. We mostly get them in the actual number of jobs being added, and the average hourly earnings numbers being revised as well to 0.4% for November from 0.6%. So in other words, wage growth is actually slowing, and it already had been slowing more than the initial look, guys.
First take here for me is that I think that's why you saw futures pop. Because of those downward revisions, jobs for October revised down by 21,000, and Julie, as you mentioned, for November, revised down to 7,000. That suggests the economy has started to cool, and that might play into some of the views on the street. Perhaps we get that Fed pivot by the middle of this year. If we didn't get those revisions, I would argue this is a pretty strong report for the economy. Really broad-based gains and much better than expected.
It is a strong report, and some of the strongest areas that were able to add on or at least contribute the most to this most recent month's employment report. It came across leisure and hospitality, healthcare, construction. You also had social assistance, and of course leisure and hospitality really trying to continue its comeback over the course of 2022. There's also a good nugget within this report about leisure and hospitality. It added an average of 79,000 jobs per month during 2022. Now, it is, of course, substantially less than the average gain of 196,000 jobs per month in 2021, but that really tells you about the recovery that's needed to take place within this sector. And so within leisure and hospitality, you really saw the most additions in food services, drinking places, people making their way back out into some of the social constructs. And the services economy is one that's certainly been trying to continue to chart that rebound here. Amusements, gambling, recreation also added about 25,000 jobs.
And just one more quick thing where we're losing jobs is in professional and business services, down 6,000, which might reflect some of the technology losses that we've talked about.